Okay, it's Friday, and that means it's time to take a look at Chris Wood's from Jefferies Greed and Fear note. Now, the new note is very interesting and is centered around the stock price action, or rather the stock market action, post the Fed's latest announcement. It's also based on whether Greed and Fear actually believes in the future stimulus program or not. And then finally, it also talks about the bubble in tech having some resemblances to the 2000 dot-com bubble. Now, I'm going to begin with the Fed announcement. It's very interesting that the stock market sold off during the Fed meet pivot press conference yesterday. So typically when you hear about central banks talking about a low interest rate environment persisting in the economy, that coupled with possibly the third round of stimulus that the USA and other key stimulus printers like the Bank of Japan and the Bank of England would subsequently be doing, it's very surprising that the stock market did not react in a positive way. The last two times, or the last time we had a major stimulus announcement, we saw a one-way reaction with equities that has pretty much landed us where we are today, and the rally has been stupendous from April, May when these stimulus announcements were made. So why then did the same reaction not happen this time? Well, according to Greed and Fear, it's because the Fed couldn't explain why the Fed forecast not showing an inflation above 2% in 2023, despite a decision to target inflation above 2%. So that didn't make sense to them, and it's something that got their guards up to a certain extent. Greed and Fear does not believe in the forward guidance nor approach to policy practiced by the Fed. So now this entire approach of helicoptering money from our future generations over ourselves currently is something that Greed and Fear is not too fond of. The Fed did also not announce a switch in its asset purchases in favor of longer dated Treasury bonds. So that's another key one, because this would have allowed for more room on the yield curve steepening. Now, this has also not happened, which is something that comes as a disappointment. Finally, he talks about the resemblances to 2000 dot-com bubble. Recent weeks have reminded Greed and Fear of the top in the dot-com bubble back in March of 2000. US big tech's relative outperformance has finally peaked out, according to them. Tech stocks will not be rallying anymore the way they have, at least in recent weeks. The only difference between this time and the dot-com bubble of 2000 is that there was an obvious catalyst trigger to sell off beyond the ludicrous valuations. This time we only have the ludicrous valuations as of now. Monetary tightening, as Pinball Allen unwound the excessive monetary easing implemented ahead of 2000. So back then we actually had monetary tightening, not monetary loosening, which is what we're seeing today. Finally, what he says is that if the world returns to normalcy, which will be sooner rather than later, it would be very negative for the big US tech companies, which have currently had a tremendous benefit on the back of increased usage of their products, bandwidth and data services by us while we all stay at home. So once this also stabilizes and we return to normal existence, the traction that we're seeing for a lot of the big tech players might fade away. So these are broadly the warnings he's flagging off in his latest note, and seeming quite cautious on equity.